In finance, a derivative is a special type of contract which derives its value from the performance of an underlying entity. This underlying entity can be an asset, index, or interest rate, and is often called the underlying. Derivatives can be used for a number of purposes, including insuring against price movements, increasing exposure to price movements for speculation, or getting access to otherwise hard-to-trade assets or markets. Some of the more common derivatives include futures, forwards, swaps, options, and variations of these such as caps, floors, collars, and credit default swaps. Most derivatives are traded over the counter or on an exchange such as the Chicago Mercantile Exchange, while most insurance contracts have developed into a separate industry. Derivatives are one of the three main categories of financial instruments, the other two being equities and debt. Basics: derivatives are a contract between two parties that specify conditions under which payments are to be made between the parties. The most common underlying assets include commodities, stocks, bonds, interest rates and currencies, but they can also be other derivatives, which adds another layer of complexity to proper valuation. The components of a firm's capital structure, for example bonds and stock, can also be considered derivatives, more precisely options, with the underlying being the firm's assets, but this is unusual outside of technical contexts. There are two groups of derivative contracts: the privately traded over-the-counter derivatives such as swaps that do not go through an exchange or other intermediary, and exchange-traded derivatives that are traded through specialized derivatives exchanges or other exchanges. Derivatives are more common in the modern era, but their origins trace back several centuries. One of the oldest derivatives is rice futures, which have been traded on the Dajima Rice Exchange since the 18th century. Derivatives are broadly categorized by the relationship between the underlying asset and the derivative. The type of underlying asset, the market in which they trade, and their payoff profile. Derivatives may broadly be categorized as lock or option products. Lock products obligate the contractual parties to the terms over the life of the contract. Option products provide the buyer the right, but not the obligation to enter the contract under the terms specified. Derivatives can be used either for risk management or for speculation. This distinction is important because the former is a prudent aspect of operations and financial management for many firms across many industries. The latter offers managers and investors a risky opportunity to increase profit, which may not be properly disclosed to stakeholders. Along with many other financial products and services, derivatives reform is an element of the Dodd-Euro-Franc Wall Street Reform and Consumer Protection Act of 2010. The Act delegated many rule-making details of regulatory oversight to the Commodity Futures Trading Commission, and those details are not finalized nor fully implemented as of late 2012. Size of market: to give an idea of the size of the derivative market, The Economist magazine has reported that as of June 2011, the over-the-counter derivatives market amounted to approximately $700 trillion, and the size of the market traded on exchanges totaled an additional $83 trillion. However, these are notional values, and some economists say that this value greatly exaggerates the market value and the true credit risk faced by the parties involved. For example, in 2010, while the aggregate of OTC derivatives exceeded $600 trillion, the value of the market was estimated much lower, at $21 trillion. The credit risk equivalent of the derivative contracts was estimated at $3.3 trillion. Still, even these scaled-down figures represent huge amounts of money. For perspective, the budget for total expenditure of the United States government during 2012 was $3.5 trillion, and the total current value of the U.S. stock market is an estimated $23 trillion. The world annual gross domestic product is about $65 trillion. And for one type of derivative at least, credit default swaps, for which the inherent risk is considered high, the higher, nominal value, remains relevant. It was this type of derivative that investment magnate Warren Buffett referred to in his famous 2002 speech, in which he warned against weapons of financial mass destruction. CDS notional value in early 2012 amounted to $25.5 trillion, down from $55 trillion in 2008. Usage: derivatives are used for the following: hedge or mitigate risk in the underlying, by entering into a derivative contract whose value moves in the opposite direction to their underlying position and cancels part or all of it out. Create optionability where the value of the derivative is linked to a specific condition or event. Obtain exposure to the underlying where it is not possible to trade in the underlying. Provide leverage, such that a small movement in the underlying value can cause a large difference in the value of the derivative. Speculate and make a profit if the value of the underlying asset moves the way they expect. Switch asset allocations between different asset classes without disturbing the underlying assets. As part of transition management, avoid paying taxes. For example, an equity swap allows an investor to receive steady payments, for example based on LIBOR rate, while avoiding paying capital gains tax and keeping the stock. Mechanics and valuation basics: lock products are theoretically valued at zero at the time of execution and thus do not typically require an upfront exchange between the parties. Based upon movements in the underlying asset over time, however, the value of the contract will fluctuate, and the derivative may be either an asset or a liability at different points throughout its life. Importantly, either party is therefore exposed to the credit quality of its counterparty and is interested in protecting itself in an event of default. Option products have immediate value at the outset because they provide specified protection over a given time period. One common form of option product familiar to many consumers is insurance for homes and automobiles. The insured would pay more for a policy with greater liability protections and one that extends for a year rather than 6 months. Because of the immediate option value, the option purchaser typically pays an upfront premium. Just like for lock products, movements in the underlying asset will cause the option's intrinsic value to change over time while its time value deteriorates steadily until the contract expires. An important difference between a lock product is that, after the initial exchange, the option purchaser has no further liability to its counterparty. Upon maturity, the purchaser will execute the option if it has positive value or expire at no cost. Hedging. Derivatives allow risk related to the price of the underlying asset to be transferred from one party to another. For example, a wheat farmer and a miller could sign a futures contract to exchange a specified amount of cash for a specified amount of wheat in the future. Both parties have reduced a future risk, for the wheat farmer, the uncertainty of the price, and for the miller, the availability of wheat. However, there is still the risk that no wheat will be available because of events unspecified by the contract, such as the weather, or that one party will renege on the contract. Although a third party, called a clearinghouse, insures a futures contract, not all derivatives are insured against counterparty risk. From another perspective, the farmer and the miller both reduce a risk and acquire a risk when they sign the futures contract. The farmer reduces the risk that the price of wheat will fall below the price specified in the contract and acquires the risk that the price of wheat will rise above the price specified in the contract. The miller, on the other hand, acquires the risk that the price of wheat will fall below the price specified in the contract and reduces the risk that the price of wheat will rise above the price specified in the contract. In this sense, one party is the insurer for one type of risk, and the counterparty is the insurer for another type of risk. Hedging also occurs when an individual or institution buys an asset and sells it using a futures contract. The individual or institution has access to the asset for a specified amount of time, and can then sell it in the future at a specified price according to the futures contract. Of course, this allows the individual or institution the benefit of holding the asset, while reducing the risk that the future selling price will deviate unexpectedly from the market's current assessment of the future value of the asset. Derivatives trading of this kind may serve the financial interests of certain particular businesses. For example, a corporation borrows a large sum of money at a specific interest rate. The interest rate on the loan reprices every 6 months. The corporation is concerned that the rate of interest may be much higher in 6 months. The corporation could buy a forward rate agreement, which is a contract to pay a fixed rate of interest 6 months after purchases on a notional amount of money. If the interest rate after 6 months is above the contract rate, the seller will pay the difference to the corporation, or FRA buyer. If the rate is lower, the corporation will pay the difference to the seller. The purchase of the FRA serves to reduce the uncertainty concerning the rate increase and stabilize earnings. Speculation and arbitrage, derivatives can be used to acquire risk, rather than to hedge against risk. Thus, some individuals and institutions will enter into a derivative contract to speculate on the value of the underlying asset, betting that the party seeking insurance will be wrong about the future value of the underlying asset. Speculators look to buy an asset in the future at a low price according to a derivative contract when the future market price is high, or to sell an asset in the future at a high price according to a derivative contract when the future market price is less. Individuals and institutions may also look for arbitrage opportunities, as when the current buying price of an asset falls below the price specified in a futures contract to sell the asset. Speculative trading in derivatives gained a great deal of notoriety in 1995 when Nick Leeson, a trader at Barings Bank, made poor and unauthorized investments in futures contracts. Through a combination of poor judgment, lack of oversight by the bank's management and regulators, and unfortunate events like the Kobe earthquake, Leeson incurred a $1.3 billion loss that bankrupted the centuries-old institution. Proportion used for hedging and speculation. Unfortunately, the true proportion of derivatives contracts used for legitimate hedging purposes is unknown, but it appears to be relatively small. Also, derivatives contracts account for only 3.06% of the median firm's total currency and interest rate exposure. Nonetheless, we know that many firms' derivatives activities have at least some speculative component for a variety of reasons. Types: OTC and exchange-traded. In broad terms, there are two groups of derivative contracts, which are distinguished by the way they are traded in the market. Over-the-counter derivatives are contracts that are traded directly between two parties, without going through an exchange or other intermediary. Products such as swaps, forward rate agreements, exotic options (euro), and other exotic derivatives (euro) are almost always traded in this way. The OTC derivative market is the largest market for derivatives, and is largely unregulated with respect to disclosure of information between the parties, since the OTC market is made up of banks and other highly sophisticated parties, such as hedge funds. Reporting of OTC amounts is difficult because trades can occur in private, without activity being visible on any exchange. According to the Bank for International Settlements, who first surveyed OTC derivatives in 1995, reported that the gross market value, which represent the cost of replacing all open contracts at the prevailing market prices, increased by 74% since 2004, to $11 trillion at the end of June 2007. Positions in the OTC derivatives market increased to $516 trillion at the end of June 2007, 135% higher than the level recorded in 2004. The total outstanding notional amount is $708 trillion. Of this total notional amount, 67% are interest rate contracts, 8% are credit default swaps, 9% are foreign exchange contracts, 2% are commodity contracts, 1% are equity contracts, and 12% are other. Because OTC derivatives are not traded on an exchange, there is no central counterparty. Therefore, they are subject to counterparty risk, like an ordinary contract, since each counterparty relies on the other to perform. Exchange-traded derivatives are those derivatives instruments that are traded via specialized derivatives exchanges or other exchanges. A derivatives exchange is a market where individuals trade standardized contracts that have been defined by the exchange. A derivatives exchange acts as an intermediary to all related transactions, and takes initial margin from both sides of the trade to act as a guarantee. The world's largest derivatives exchanges are the Korea Exchange, OREX, and CME Group. According to BIS, the combined turnover in the world's derivatives exchanges totaled $344 trillion during Q4 2005. By December 2007, the Bank for International Settlements reported that derivatives traded on exchanges surged 27% to a record $681 trillion. Common derivative contract types: Some of the common variants of derivative contracts are as follows. Forwards, a tailored contract between two parties, where payment takes place at a specific time in the future at today's predetermined price. Futures are contracts to buy or sell an asset on or before a future date at a price specified today. A futures contract differs from a forward contract in that the futures contract is a standardized contract written by a clearinghouse that operates an exchange where the contract can be bought and sold. The forward contract is a non-standardized contract written by the parties themselves. Options are contracts that give the owner the right, but not the obligation, to buy or sell an asset. The price at which the sale takes place is known as the strike price, and is specified at the time the parties enter into the option. The option contract also specifies a maturity date. In the case of a European option, the owner has the right to require the sale to take place on the maturity date. In the case of an American option, the owner can require the sale to take place at any time up to the maturity date. If the owner of the contract exercises this right, the counterparty has the obligation to carry out the transaction. Options are of two types, call option and put option. The buyer of a call option has a right to buy a certain quantity of the underlying asset, at a specified price on or before a given date in the future. He however has no obligation whatsoever to carry out this right. Similarly, the buyer of a put option has the right to sell a certain quantity of an underlying asset, at a specified price on or before a given date in the future. He however has no obligation whatsoever to carry out this right. Binary options are contracts that provide the owner with an all-or-nothing profit profile. Warrants, apart from the commonly used short-dated options which have a maximum maturity period of 1 year, there exists certain long-dated options as well, known as warrant. These are generally traded over the counter. Swaps are contracts to exchange cash on or before a specified future date based on the underlying value of currencies exchange rates, bonds interest rates, commodities exchange, stocks or other assets. Another term which is commonly associated to swap is swaption, which is basically an option on the forward swap. Similar to a call and put option, a swaption is of two kinds, a receiver swaption and a pair swaption. While on one hand, in case of a receiver swaption there is an option wherein you can receive fixed and pay floating, a pair swaption on the other hand is an option to pay fixed and receive floating. Swaps can basically be categorized into two types. Interest rate swap, these basically necessitate swapping only interest-associated cash flows in the same currency, between two parties. Currency swap, in this kind of swapping, the cash flow between the two parties includes both principal and interest. Also, the money which is being swapped is in different currency for both parties. Some common examples of these derivatives are the following. Economic function of the derivative market. Some of the salient economic functions of the derivative market include, prices in a structured derivative market not only replicate the discernment of the market participants about the future but also lead the prices of underlying to the professed future level. On the expiration of the derivative contract, the prices of derivatives congregate with the prices of the underlying. Therefore, derivatives are essential tools to determine both current and future prices. The derivatives market reallocates risk from the people who prefer risk aversion to the people who have an appetite for risk. The intrinsic nature of derivatives market associates them to the underlying spot market. Due to derivatives there is a considerable increase in trade volumes of the underlying spot market. The dominant factor behind such an escalation is increased participation by additional players who would not have otherwise participated due to absence of any procedure to transfer risk. As supervision, reconnaissance of the activities of various participants becomes tremendously difficult in assorted markets. The establishment of an organized form of market becomes all the more imperative. Therefore, in the presence of an organized derivatives market, speculation can be controlled, resulting in a more meticulous environment. Third parties can use publicly available derivative prices as educated predictions of uncertain future outcomes, for example, the likelihood that a corporation will default on its debts. In a nutshell, there is a substantial increase in savings and investment in the long run due to augmented activities by derivative market participant. Valuation. market and arbitrage-free prices. Two common measures of value are, market price, that is the price at which traders are willing to buy or sell the contract, arbitrage-free price, meaning that no risk-free profits can be made by trading in these contracts, determining the market price. For exchange-traded derivatives, market price is usually transparent. Complications can arise with OTC or floor-traded contracts though, as trading is handled manually, making it difficult to automatically broadcast prices. In particular with OTC contracts, there is no central exchange to collate and disseminate prices. Determining the arbitrage-free price, see List of finance topics. Derivatives pricing. The arbitrage-free price for a derivatives contract can be complex, and there are many different variables to consider. Arbitrage-free pricing is a central topic of financial mathematics. For futures forwards, the arbitrage-free price is relatively straightforward, involving the price of the underlying together with the cost of carry, although there can be complexities. However, for options and more complex derivatives, pricing involves developing a complex pricing model. Understanding the stochastic process of the price of the underlying asset is often crucial. A key equation for the theoretical valuation of options is the Blacker-Scholes formula, which is based on the assumption that the cash flows from a European stock option can be replicated by a continuous buying and selling strategy using only the stock. A simplified version of this valuation technique is the binomial options model. OTC represents the biggest challenge in using models to price derivatives. Since these contracts are not publicly traded, no market price is available to validate the theoretical valuation. Most of the model's results are input-dependent. Therefore it is common that OTC derivatives are priced by independent agents that both counterparties involved in the deal designate upfront. Criticisms. Derivatives are often subject to the following criticisms. Hidden tail risk, according to Raghuram Rajan, a former chief economist of the International Monetary Fund. It may well be that the managers of these firms, investment funds, have figured out the correlations between the various instruments they hold and believe they are hedged. Yet as Chan and others point out, the lessons of summer 1998 following the default on Russian government debt is that correlations that are zero or negative in normal times can turn overnight to one. A phenomenon they term phase lock, and a hedged position can become unhedged at the worst times, inflicting substantial losses on those who mistakenly believe they are protected. Risks. The use of derivatives can result in large losses because of the use of leverage, or borrowing. Derivatives allow investors to earn large returns from small movements in the underlying asset's price. However, investors could lose large amounts if the price of the underlying moves against them significantly. There have been several instances of massive losses in derivative markets, such as the following. American International Group lost more than $18 billion through a subsidiary over the preceding 3 quarters on credit default swaps. The United States Federal Reserve Bank announced the creation of a secured credit facility of up to $85 billion, to prevent the company's collapse by enabling AIG to meet its obligations to deliver additional collateral to its credit default swap trading partners. The loss of $7.2 billion by Social Copyright TAR Copyright GAR Copyright NAR Copyright Rail in January 2008 through misuse of futures contracts. The loss of $6.4 billion in the failed fund Amaranth Advisors, which was long natural gas in September 2006 when the price plummeted. The loss of $4.6 billion in the failed fund Long-Term Capital Management in 1998. The loss of $1.3 billion equivalent in oil derivatives in 1993 and 1994 by Metallgesellschaft AG. The loss of $1.2 billion equivalent in equity derivatives in 1995 by Barings Bank. UBS AG, Switzerland's biggest bank, suffered a $2 billion loss through unauthorized trading discovered in September 2011. This comes to a staggering $39.5 billion, the majority in the last decade after the Commodity Futures Modernization Act of 2000 was passed. Counterparty risk. Some derivatives expose investors to counterparty risk, or risk arising from the other party in a financial transaction. Different types of derivatives have different levels of counterparty risk. For example, standardized stock options by law require the party at risk to have a certain amount deposited with the exchange, showing that they can pay for any losses. Banks that help businesses swap variable for fixed rates on loans may do credit checks on both parties. However, in private agreements between two companies, for example, there may not be benchmarks for performing due diligence and risk analysis. Large notional value derivatives typically have a large notional value. As such, there is the danger that their use could result in losses for which the investor would be unable to compensate. The possibility that this could lead to a chain reaction ensuing in an economic crisis was pointed out by famed investor Warren Buffett in Berkshire Hathaway's 2002 annual report. Buffett called them financial weapons of mass destruction. A potential problem with derivatives is that they comprise an increasingly larger notional amount of assets which may lead to distortions in the underlying capital and equities markets themselves. Investors begin to look at the derivatives markets to make a decision to buy or sell securities, and so what was originally meant to be a market to transfer risk now becomes a leading indicator. See Berkshire Hathaway Annual Report for 2002, Financial Reform and Government Regulation. Under U.S. law and the laws of most other developed countries, derivatives have special legal exemptions that make them a particularly attractive legal form to extend credit. The strong creditor protections afforded to derivatives counterparties, in combination with their complexity and lack of transparency, however, can cause capital markets to underprice credit risk. This can contribute to credit booms, and increase systemic risks. Indeed, the use of derivatives to conceal credit risk from third parties while protecting derivative counterparties contributed to the financial crisis of 2008 in the United States. In the context of a 2010 examination of the ICE Trust, an industry self-regulatory body, Gary Gensler, the chairman of the Commodity Futures Trading Commission which regulates most derivatives, was quoted saying that the derivatives marketplace as it functions now adds up to higher costs to all Americans. More oversight of the banks in this market is needed, he also said. Additionally, the report said, the Department of Justice is looking into derivatives too. The department's antitrust unit is actively investigating the possibility of anti-competitive practices in the credit derivatives clearing, trading and information services industries, according to a department spokeswoman. For legislators and committees responsible for financial reform related to derivatives in the United States and elsewhere, distinguishing between hedging and speculative derivatives activities has been a non-trivial challenge. The distinction is critical because regulation should help to isolate and curtail speculation with derivatives, especially for systemically significant institutions whose default could be large enough to threaten the entire financial system. At the same time, the legislation should allow for responsible parties to hedge risk without unduly tying up working capital as collateral that firms may better employ elsewhere in their operations and investment. In this regard, it is important to distinguish between financial and non-financial end users of derivatives because these firms' derivatives usage is inherently different. More importantly, the reasonable collateral that secures these different counterparties can be very different. The distinction between these firms is not always straightforward. Finally, even financial users must be differentiated, as large banks may be classified as systemically significant, whose derivatives activities must be more tightly monitored and restricted than those of smaller, local and regional banks. Over-the-counter dealing will be less common as the Dodd-Euro-Franc Wall Street Reform and Consumer Protection Act comes into effect. The law mandated the clearing of certain swaps at registered exchanges and imposed various restrictions on derivatives. To implement Dodd-Frank, the CFTC developed new rules in at least 30 areas. The Commission determines which swaps are subject to mandatory clearing and whether a derivatives exchange is eligible to clear a certain type of swap contract. Nonetheless, the above and other challenges of the rule-making process have delayed full enactment of aspects of the legislation relating to derivatives. The challenges are further complicated by the necessity to orchestrate globalized financial reform among the nations that comprise the world's major financial markets, a primary responsibility of the Financial Stability Board whose progress is ongoing. In the U.S., by February 2012 the combined effort of the SEC and CFTC had produced over 70 proposed and final derivatives rules. However, both of them had delayed adoption of a number of derivatives regulations because of the burden of other rulemaking, litigation and opposition to the rules, and many core definitions had still not been adopted. SEC Chairman Mary Shapiro opined, "At the end of the day, it probably does not make sense to harmonize everything between the SEC and CFTC rules because some of these products are quite different and certainly the market structures are quite different." In November 2012, the SEC and regulators from Australia, Brazil, the European Union, Hong Kong, Japan, Ontario, Quebec, Singapore, and Switzerland met to discuss reforming the OTC derivatives market, as had been agreed by leaders at the 2009 G20 Pittsburgh Summit in September 2009. In December 2012, they released a joint statement to the effect that they recognize that the markets is a global one and firmly support the adoption and enforcement of robust and consistent standards in and across jurisdictions, with the goals of mitigating risk, improving transparency, protecting against market abuse, preventing regulatory gaps, reducing the potential for arbitrage opportunities, and fostering a level playing field for market participants. They also agreed on the need to reduce regulatory uncertainty and provide market participants with sufficient clarity on laws and regulations by avoiding, to the extent possible, the application of conflicting rules to the same entities and transactions, and minimizing the application of inconsistent and duplicative rules. At the same time, they noted that complete harmonization perfect alignment of rules across jurisdictions would be difficult, because of jurisdictions' differences in law, policy, markets, implementation timing, and legislative and regulatory processes. On December 20, 2013 the CFTC provided information on its swaps regulation comparability determinations. The release addressed the CFTC's cross-border compliance exceptions. Specifically it addressed which entity-level and in some cases transaction-level requirements in 6 jurisdictions it found comparable to its own rules, thus permitting non-U.S. swap dealers, major swap participants, and the foreign branches of U.S. swap dealers and major swap participants in these jurisdictions to comply with local rules in lieu of Commission rules. Reporting: mandatory reporting regulations are being finalized in a number of countries, such as Dodd-Frank Act in the U.S., the European Market Infrastructure Regulations in Europe, as well as regulations in Hong Kong, Japan, Singapore, Canada, and other countries. The OTC Derivatives Regulators Forum, a group of over 40 worldwide regulators, provided trade repositories with a set of guidelines regarding data access to regulators, and the Financial Stability Board and CPSSIOSCO also made recommendations with regard to reporting. DTCC, through its Global Trade Repository Service, manages global trade repositories for interest rates, and commodities, foreign exchange, credit, and equity derivatives. It makes global trade reports to the CFTC in the U.S., and plans to do the same for ESMA in Europe and for regulators in Hong Kong, Japan, and Singapore. It covers cleared and uncleared OTC derivatives products, whether or not a trade is electronically processed or bespoke. Glossary: bilateral netting, a legally enforceable arrangement between a bank and a counterparty that creates a single legal obligation covering all included individual contracts. This means that a bank's obligation, in the event of the default or insolvency of one of the parties, would be the net sum of all positive and negative fair values of contracts included in the bilateral netting arrangement. Counterparty, the legal and financial term for the other party in a financial transaction. Credit derivative, a contract that transfers credit risk from a protection buyer to a credit protection seller. Credit derivative products can take many forms, such as credit default swaps, credit-linked notes and total return swaps. Derivative, a financial contract whose value is derived from the performance of assets, interest rates, currency exchange rates, or indexes. Derivative transactions include a wide assortment of financial contracts including structured debt obligations and deposits, swaps, futures, options, caps, floors, collars, forwards and various combinations thereof. Exchange-traded derivative contracts, standardized derivative contracts that are transacted on an organized futures exchange. Gross negative fair value, the sum of the fair values of contracts where the bank owes money to its counterparties, without taking into account netting. This represents the maximum losses the bank's counterparties would incur if the bank defaults and there is no netting of contracts, and no bank collateral was held by the counterparties. Gross positive fair value, the sum total of the fair values of contracts where the bank is owed money by its counterparties, without taking into account netting. This represents the maximum losses a bank could incur if all its counterparties default and there is no netting of contracts, and the bank holds no counterparty collateral. High-risk mortgage securities, securities where the price or expected average life is highly sensitive to interest rate changes, as determined by the U.S. Federal Financial Institutions Examination Council policy statement on high-risk mortgage securities. Notional amount, the nominal or face amount that is used to calculate payments made on swaps and other risk management products. This amount generally does not change hands and is thus referred to as notional. Over-the-counter derivative contracts, privately negotiated derivative contracts that are transacted off organized futures exchanges. Structured notes, non-mortgage-backed debt securities, whose cash flow characteristics depend on one or more indices and or have embedded forwards or options. Total risk-based capital, the sum of Tier 1 plus Tier 2 capital. Tier 1 capital consists of common shareholders' equity, perpetual preferred shareholders' equity with non-cumulative dividends, retained earnings, and minority interests in the equity accounts of consolidated subsidiaries. Tier 2 capital consists of subordinated debt, intermediate-term preferred stock, cumulative and long-term preferred stock, and a portion of a bank's allowance for loan and lease losses. See also. References. Further reading, Bartram, Czar Paragraph HNKEM. Brown, Gregory W. Conrad, Jennifer C. The Effects of Derivatives on Firm Risk and Value. Journal of Financial and Quantitative Analysis 46, 967 €999 Aretz, Kevin. Bartram, Czar Paragraph HNKEM Corporate Hedging and Shareholder Value. Journal of Financial Research 33, 317 €371 Bartram, Czar Paragraph HNKEM. Brown, Gregory W. Verheul, Franker International Evidence on Financial Derivatives Usage. Financial Management 38, 185 €206 Lemke, Linz. Soft Dollars and Other Trading Activities. Thomson Wester, Institute for Financial Markets. Futures and Options. Washington, D.C., Institute for Financial Markets. ISBN A978-0-615-35082-0. Hull, John C. Options, Futures and Other Derivatives. Harlow, Pearson Education. ISBN A978-0-13-260460-4, Durbin, Michael. All About Derivatives. New York, McGraw-Hill. ISBN A978-0-07-174351-8. Matu, Miraj. Structured Derivatives, New Tools for Investment Management, A Handbook of Structuring, Pricing and Investor Applications. London, Financial Times. ISBN A978-0-273-61120-2. Sokolokov, A.N., Deriving Derivatives, http, Papers SSRN Compapers CFM. Abstracted equals 2,262,941 and Elasticity Theory of Structuring, http, Papers SSRN Compapers CFM. Abstracted equals 2,262,963, external links. BBC News Euro Derivatives Simple Guide, European Union Proposals on Derivatives Regulation Euro 2008 onwards, PwC Financial Services Regulatory Practice, Derivatives Regulatory Roulette.